Hi, so in today's video, what I'm going to do is I'm going to talk about why holding companies can be quite a useful tax planning tool and when and where they are appropriate. So before I go into this, I just wanted to remind you, we've got some amazing content on our website, naccounting.co.uk. We've got more of these videos, we've got our podcast, we've got our webinar, we've got our free guide, we've got our blogs, and we've got information about our quarterly planning days. So it's definitely worth checking out our website, naccounting.co.uk. And just in addition to that, if you've got any questions about these videos, then you can book yourself in for a call with me on our website. So going back to this, what are holding companies and when are they useful? Well, a lot of business owners have heard about holding companies, but I haven't seen a lot of content out there which really explains what they do. So holding company is essentially a company where it can hold the shares in your main business. Most business owners out there, they will own shares in their business themselves. So they might have a limited company and they might have 100 shares in that limited company. What I'm suggesting is when you have a holding company, the business owner then owns all the shares in the holding company, and then the holding company then owns shares in that business. And I wanted to explain in this video why it's quite important to do that. But it's not always important. So I'll give you a scenario. Let's say you're running a business with a business partner and you're running it as a limited company. Well, you might have other things going on in your finances, right? And you may be trying to be tax efficient. So you may have said, okay, well, this year I don't want to go over £50,000 in income because I don't want to pay the high rate of tax. I don't want to lose my child benefit. That's fair enough. But let's say you've got £30,000 coming from other sources. That means you can only have £20,000 coming from this limited company you own with your business partner before it pushes you into the higher rate of tax. But in another scenario, the same scenario, but on the other side, your business partner might have no other income, but they want to earn £50,000 before they pay the higher rate of tax. And when they want to earn £50,000 and you're equal partners in that business, if they want to earn £50,000 from that business, you've got to earn £50,000 from that business. So now you've got a conflict. You only want to take out 20, so you don't get pushed into the high rate. They want to take out 50 before they get pushed into the high rate. So who's going to win? Do you limit them to £20,000 of income, which they'll be unhappy with, and then they'll waste a lot of their basic rate? Or do you take the hit and have an extra 30,000 more than you wanted and then pay the high rate tax on it, plus lose your child benefit? Interesting. Okay, well, the solution here is to have a holding company. So if you go and set up a holding company and then you do what we call a share-to-share transfer, share-for-share transfer, then actually you can move the shares, move your shares that you own in your trading business into your holding company without having to pay any capital gains or stamp duty on it. But what that means is then you own the holding company, then the holding company owns half of this other company. So now what happens is you can oblige your business partner's request and you say, okay, well, you want to take out 50,000. Let's say the business made enough money to pay that out in salary and dividends. You want to take out 50,000, no problem. I'll take the 50 as well, because what will happen is your 50,000 is going to go straight out to you and you're going to pay the basic rate tax on it. You're not going to get pushed into the high rate. My 50,000 is going to get paid out into my holding company, and my holding company is then only going to pay out 20,000 to me, and then I'm going to leave 30,000 of retained earnings in my holding company. And that means that down the line, if I want to invest it some other way, like maybe through an SPV or to buy rental properties, or if I want to pay it into my pension at a different point, or if I want to just take it at another time, I can do that at my leisure and pay the tax when I decide to pay it, rather than just be forced to pay the high rate tax, which would happen if I didn't have the holding company. And that's the win-win scenario where you've got a business partner with other objectives different to yours. And that happens a lot, and that's where we really use the holding companies, where you've got businesses that have multiple partners, but they're not family members. Usually with a husband and wife, it's not as applicable, because a husband and wife, it's quite straightforward to be able to split the income. Well, naturally split the income, not artificially split it, but it's straightforward to structure the income. So husband and wives tend to have the same amount each anyway. But with businesses where you've got multiple partners, then there's varying tax objectives, and the holding company can really be a really good tool to help you take money out of the business without paying tax on it at unfavorable rates, and then deal with that money when the time is right for you. And that's why people use holding companies. All right, if you found this video useful, remember to like, share, follow, and subscribe. Check out our website. You can get in touch with me there as well and book a call. And I'll see you at the next video.